Hi, everybody. This is Hyperwave, and we have a special guest on today, Haeijin Lee. And I am really excited about this one because I am not very good at Elliott waves. And we have two waves here. So this is really going to be great. I'm hoping that Haeijin, we've been following you. Tyler, I'm gonna put you on the spot here, but Tyler's been following you for a very long time, daily, all your shows. We love also how you overlay Fibonacci on stuff. I'm gonna maybe ask some tough questions, just so that we can also see how hyperwaves and Elliott waves are different. And also, Tyler has an interesting background in Elliott waves, so I assume you guys are gonna have fun riffing off each other and each other's analysis a little. But Haeijin, thank you so much for joining us. Tell us also, a little bit as much as you can about, your background of, why did you learn Elliott waves and, how are you so good at them? And, just thanks for joining.
Absolutely. Well, like I always start my videos, good morning, good evening, good afternoon, depending on where you are. This is Haeijin Lee. I'm very happy to be on the show with Tyler and Leah. This is going to be time well spent. So just as a quick introduction, I guess back in 1997, when I was 27 years old, I picked up the book by Edwards and McGee, Technical Analysis of Stock Trends. And the pattern recognitions just flew at me. I just really was into it, and I that's what I wanted to become the next next $10 million heir in the family. So I opened up back then E-Trade account, which was pretty new. Online trading was very new back in 1997 and mid 90s. So I opened up an E-Trade account and promptly brought my account to zero. I lost everything. And I realized, oh my goodness, what do I do? What do I even tell my wife? And how do I even approach this? So then I tried again. Make a long story short, back in 2000, when the dot-com bubble was brewing, and I was making a lot of money. I tried again, but I didn't use just chart analysis. That's when I got into Elliott waves. And then that's when I started. Well, I abandoned temporarily the chart waves, saying this stinks, it doesn't work. Then I used Elliott waves. I thought, oh, this is a next golden thing. Now I'm going to make my money back and my $10 million. Well, I probably lost all my money again. And my wife knows exactly how much money I lost. Now, after that, I think failure is the best teacher in life. So having failed and brought multiple accounts to zeros, I think what I did was I realized that a good trader is always a bad trader who forgives himself for his mistakes, never blames somebody else, always takes accountability, learns his lessons and tries again. And in that process, that's been my learning process. I've been combining chart pattern recognition with Elliott waves, and at times adding MACD as well as cycles. I used for a little while Hurst cycles quite extensively, and that combination, especially with chart patterns and Elliott waves, because both really any technical analysis are driven by the inner workings of Fibonacci mathematics. And because of that, all the techniques are so interrelated in many ways and similar. So since then, I've been using the chart patterns and Elliott waves pretty successfully, not to perfection, because you must understand, and this was another learning lesson for me, is that technical analysis is not based on the principle of certainty, but probability, which means you will be wrong, you will take losses, but on top of that, it was really how to take those losses, how to take those wins. And then I learned from a mentor a system of laddering my entries. To ladder my entries, instead of buying everything in a single transaction, I never do that. I ladder in and ladder out. The reason for that is because personal, to help me modulate my emotions of fear and greed. So every individual has to find their own way that works. It's going to be a unique system for them, very similar to others maybe at times, but not exact. And for me, the latter entry, to be able to establish the rungs of my entry using local support and resistance zones, so that even if my first rung purchase price goes below that, I don't panic. because I've got plenty of buy rungs below that, so to speak. So that's my way of modulating my fear and greed emotions to do what? To be able to capture the wins and minimize the losses. That is really the two outcomes that I try to achieve for. And then I got into Steemit. And there, my objective early on was to help and do no harm. And I think I did a lot of that. In fact, I know I did a lot of that based on the following that I have. There was a bit of a ruckus there with regards to how much you can upvote yourself, etc., what have you. Well, we'll put that aside for now. But and then I joined Bitcoin Live. Bob Lucas approached me, great guy, very, very seasoned, experienced cycle analyst himself, to join Bitcoin Live as part of a group of analysts. I had a lot of fun. It was very productive. I was able to meet a lot of new people, followers, but after a year, I wanted to really expand on my Haeijin brand, and I thought the best way to enable that is to go individual. So I have since then, recently, about a week ago, decided not to continue a second year with Bitcoin Live, and I've just launched Haeijin.com site, which is a subscription member base, but it does have a public blog section as well. So that's been going pretty well, keeping me very busy. But again, coming back to this, I look forward to having a real enjoyable chat with you, Tyler and Leah. Thank you.
Well, thank you very much, Haeijin, because as Leah said, I've only gotten into the YouTube space and the Twitter space in the last year, following the summer of 2017. And the first thing I did was to scour who was doing what. And there's over 100 different technical broadcasters. And I quickly saw that there was only 4 or 5 or 6 that I had very much confidence in, mainly because they started out by saying, here's what you must know. Everything is probability, not certainty, number one. Number two is the most important thing you can learn is money management. And no matter what tools you use, you have to realize that you need to control your risks and be very careful about letting your rewards run. And number three, no matter what system someone uses or talks about, that I listened very carefully to make sure that there were multiple other systems that they used to check and verify that the work they were doing on the system that they preferred. And it quickly became obvious that there were very few people that had the experience to do all of those things. So many of them in the crypto space used a couple of techniques for speculation and short-term trades and did very well in the bull market, and then left everything on the table in the subsequent bear market over the last 15 months. And those that did not had very carefully adopted those 3 principles that you have just stated and I have just stated. As I said, I was very happy that Leah contacted me and said, let's take some of your 40 years of experience outside of the crypto world in terms of not only the technicals, but the fundamentals and the macroeconomics, and bring it into the crypto world, just to allow people to see that there's a much bigger world out there. One of the things that Leah and I have stated over and over from the beginning is that all asset classes are the same, including the crypto. That doesn't mean they don't have distinctions. And the distinctions in crypto are the tremendous illiquidity and the tremendous volatility, and therefore tremendous potential for reward and risk. So you need to adopt those systems that allow you to understand, but not to neglect the fact that at any point in time, there are other very important asset classes that you can and should be taken advantage of, and not to become married to any of them, regardless of how wonderful they seem to you, either philosophically or theologically or technically or fundamentally. So with that very quick overview, I thought what I would do is do a quick screen share, and I'm going to pull up what we call the archetype of the hyperwave, just to get into a little deeper our discussion about the relationship possibly between Elliott and hyperwave, and also to get your views of a number of different topics that Leah and I think are very important today, including the gold market, the S&P, as well as the crypto market. So the first thing I'm going to do here is pull up the archetype, and you see it right here. What this is, what you're looking at is you're looking at a formation that does have some interesting Elliott appearances to it, but at the same time it's unique. The reason hyperwave is unique is the pattern that you see here, we have found in 400 plus cases going back 100 years, and in each one of the cases they're identical. This pattern of 1, 2, 3, 4, 5, 6, and 7 has repeated itself in markets around the world, but usually markets that are being affected by macroeconomic shifts, going back into the 1920s, in the 30s and 40s and 50s, again in the 70s, a tremendous number of them because of the hyperinflation. And then in recent years, the Japanese stock market peaking in 1989, the dot-com bubble peaking in 2000, the mortgage market peaking in 2007, and currently what we are seeing with stock markets around the world, particularly in the United States. Now, the way a hyperwave works is the 7 phases you see here are not price. It is a structure that price is going to move up and down above or below each of these lines. Each of the lines are called phase lines. And you see that 3 of them, 1, 5, and 7, are red, and 4 of them, 2, 3, 4, and 6, are green. And what that means is the price will stay below all of the red lines and stay above all of the green lines. And if and when any of those lines are broken, then the next phase begins or the entire hyperwave ends. 2 things I'd like to point out that make it different than almost all other technical patterns. This pattern stands on its own. Once it begins, it will end with 7 returning back down to 1. Now, most people realize that what we're looking at is a bubble. All hyperwaves are bubbles, but very, very few bubbles are hyperwaves. And what that means is what looks like a parabolic move here from 1 up until the peak at 4 is not parabolic. It is actually linear, and each of these phase lines, the most important thing are these vertexes between each of the phase lines. A vertex is a point. It does not exist in reality. It has no size, has no shape, but what it does is it begins a 2-dimensional move between 2 vertexes in the form of a line. These lines are the most powerful lines I've ever seen in technical analysis. Yes, they are trend lines, but they are something much greater, because a phase line is much more powerful, much stronger than the typical trend line, either horizontal or angular. So the way a hyperwave works, this is not a short-term move. This occurs over many, many years, sometimes as long as 80 years. In the case of the credit market, that interest rates increased for 40 years from 1942 up till 1979, and then for 40 years back down. All of that took the form of a hyperwave. The shortest ones we've ever seen last about 5 or 6 years. The current one in Bitcoin has gone on for 9 years, and it's still going on in its phase 7, working its way down to a final bottom. So in very simple terms, this is not something that is very useful. Why is it not very useful? Because they rarely occur. You need to find them, you need to be able to identify them, and once you've done that, you can capture an entire move up and know precisely at which point that move is ended by the rules of Hyperwave, which we're not going to go into today, but those that have taken our workshop and those that will be able to read our book that comes out later this year will be able to see what all the rules are. It's really quite complicated. But what I wanted to just stress in as short a period of time as possible is the fact that this is a standalone pattern that does not continue the way Elliott does. The marvelous thing about Elliott wave is it applies to all markets at all times through a hierarchy that runs from the top, a grand super cycle down through super cycles and cycles all the way down to minuet and as low as you want to get. And the practitioners of Elliott know that, and know that at any point they can look at any asset and find exactly where it is in an Elliott count. Now, I loved what you said. I agree completely with you that you get two Elliotticians in a room together, they are not going to agree very rarely on precisely where you are in the count. And one of the things I found frustrating about Elliott, which I've studied since the 1970s, when one of my partners, when I first got into the business, was a master Elliottician. I ended up reading all of R.N. Elliott's writings, studying everything I could from Frost and Prechter, and then for 17 years got every one of the monthly international updates from Prechter and Prechter's group, and found it very frustrating at any point in time to be able to tell exactly where I was. So one of the reasons I wanted Haeijin on the show with us today is because of his remarkable modesty in describing at any point in time where we are, showing both the bull and the bear possibilities and the numerous possibilities of having to go back and reconfigure the analysis. So with that, I'm going to jump off this screen share, and what I would like to do is ask just very specifically the question of the difficulty in at any point in time telling where you are in Elliott, and how is your approach to answering that question for yourself and your viewers?
Well, thank you. That was a good review of the hyperwaves. Just a couple of points. My impression of the hyperwaves is that I think it's clearly augmentation oriented to any other analysis. However, the scarcity of a true hyperwave that actually fulfills to the bottom of the 7th phase itself, I think it probably is one reason why you use a lot of other techniques and analysis methods to decide on your investment buys and sell. And I think it's a great guideline from a longer term perspective or strategic perspective. And to me, strategy and tactical is really time-based for trading. Strategy for me is more of an investor class strategy. Tactical for me is very much on a swing trade type of level. and the longevity and the scarcity of a hyperwave, because it does take quite a bit of time, often would really guide. If you can get it on the phase 2, my goodness, sure, you can ride it up to the phase 5. However, the criteria of Elliott waves to find impulses, 5 waves and 3 waves, I call it family of 3 waves, or the clan of 5 waves, to teach newbies on Elliott waves. The fact that it occurs at all degrees of trend all at the same time is the attractive factor for me. The reason is because whether you're at a daily scale, weekly scale, 10-minute scale, 15, I quite often use a 15-minute scale for trades, let's say. The fact that at all degrees of trends and times, I say it's like a Russian doll system. You got a smaller one, another bigger one, so on, forward and reverse. And that, to me, it ties very well with cycles. And Robert Prechter himself uses cycles intimately. and from what frustrated me with Elliott waves was, how long will this wave last? How long will this impulse, when will it finish, potentially? Yes, you can do time-based Fibonacci, et cetera, what have you. But I felt that combining cycles, Hurst cycles, more specifically for me, was a better way to do the time. But then again, philosophically, for me, price action is the most direct reflection of sentiment. And sentiment is the most direct reflection, I guess, of thought, so to speak. So if you're looking at just price, you are 2 degrees away from thought, from a reflective perspective. But it's the closest thing we can get. You can't really measure sentiment directly. It has to be an indirect measurement. That's why I also agree with Prechter, who often said that news and events will arrive to justify the forecast. And to me, the meaning of that is, if sentiment is the most direct reflection, price is the most direct reflection of sentiment, then the fundamentals may not be as most immediate. That's why price is the most immediate and direct reflection of sentiment. So Elliott waves, I think, does a very good job in helping you to, as Prechter himself says, look around the corner, so to speak, from a probability perspective. But it doesn't do very well on how long that peak around the corner will last. And for that, I combine quite often the cycles. Now, even the cycles has its moments of uncertainty, which is quite normal. But I really combined it with chart pattern, because quite often the chart patterns and the Elliott waves jive very well together. One thing I've had a hard time identifying is how hyperwaves jive with chart patterns. And I can see how all of these chart patterns can be embedded within a particular phase and what have you. But I always my background is as a scientist. I like to have double controls, a negative and a positive, so to speak, which is why if I'm using Elliott waves, I can get a confirmation or no confirmation using chart patterns, or vice versa. One thing about hyperwaves is I think it might be very difficult to have a confirmatory alternate method that'll say, yes, this is a hyperwave, and we are in this particular phase. So it's probably going to be experience-based, which is no problem. However, from my perspective, I use and I have looked at the hyperwaves, but I think it, like I said, is a very good way to look at the strategic potential of a price move, looking at the potentials of invalidation of hyperwave as well, but also, meanwhile, utilize the techniques that allow me to gain the best visibility perspective for the all degrees of trend and at all at the same time type of activity levels. Because that's where I think for me, the meat of the buy-sell signals reside. So that's really what I think.
That's great. Yeah,
Ta-
go ahead. Go ahead, Leah.
So I'm gonna start this moderating if I can have some fun. Haeijin, that was great. Thank you so much. Tyler, before you answer that, I would love if you could also include in your answer from a trading perspective, not just investing today, how, to Haijin's point, but also how you do utilize or not utilize Elliott waves, how you see them working and not working, given Haijin Lee was talking about that it's more difficult to validate and validate sorry, there's a lot going on around me, in Hyperwave theory. And just, again, why we overall, I guess the overall question is, given that you have such a background in Elliott waves, why we don't talk about them all that much?
Well, that's it's a great question, and it fits in very well with why we wanted this discussion today. Because hyperwaves are so rare, people need to sit up and take notice when they do occur. And the reason is because there's some macroeconomic shift taking place. As our followers know, I've used this since the 1970s to identify the run-up in gold and silver and oil, and also the top of each of those, including the top of the interest rate market in 1979 and 1980.
Ty,
Yes.
as you're going, do you want to pull up one of those charts?
Well, I will in just a second. I'm going to pull up an S&P chart and a Bitcoin chart. But just as an overall view, I was in the business of managing money for the last 40 years. And therefore, Hyperwave would come and go where I wouldn't be able to use it at all for 2, 3, 4, 5 years until another one came along. But that still gave me the ability in the late 70s to be able to call the top on all those markets. And then the beginning of a new bull market in the stock market, with its peak in 1987, Hyperwave got us out a week before the Monday drop on October the 19th of 1987. We also were able to tell people it was time to get out of the Japanese stock market in 1989. And by saying getting out, what I was saying is a shift was taking place where the fastest growing and most powerful stock market and economy in the world was catching up to the US. And in 1989, the 10 largest banks in the world were all Japanese banks. And that came to a screeching halt very closely after December 1989, because Hyperwave showed that we had moved from a 4 into a 5. And I was able to predict at that point that the Japanese market would drop all the way from 38,000 well below 10,000 and possibly hit the $6,000 level, which it did. It took 20 years to do that. But from a money management point of view, as Haeijin just pointed out, this is a strategic use of technical analysis. Because along with it, when you identify it, there's all kinds of corollaries that are tied into your observation. When the dot-com bubble started in the 1990s and ended up, because of what was going on in technology and the internet, what got carried along with the NASDAQ and the NASDAQ 100 and the S&P, which was cap weighted towards those tech stocks, was that hundreds and hundreds of other stocks and sectors of the economy got pulled up along with that, so that from 1995 to the year 2000, we had the 5 best years in stock market history. The reason for that was a hyperwave, and that hyperwave was in the NASDAQ, and that NASDAQ hyperwave was being fueled by the sectors in technology pulling all kinds of other junk with it. And the junk became barnacles on the technological side of what the internet and chip development was doing. And it ended in a bust where the hyperwave broke in March of 2000, and we had a 50% drop, which Hyperwave was able to see. Now, it wasn't simply the NASDAQ, because it then affected the Dow and the S&P and the movement between value stocks and growth stocks. In the book, we're going to go into some detail about how the only time in Warren Buffett's history he had to write his annual letter apologizing for his underperformance against all of the indexes that had gone on for 2 or 3 years, without really describing that the reason for that was growth stocks, and mainly tech stocks, had dominated all the indexes, and he didn't buy those type of stocks. So what my point is what I saw when I saw the Bitcoin chart, I knew that there was some massive macroeconomic problem that the markets were facing. And the fact that it occurred right at the end of 2007, 8, and 9 with the mortgage debacle told me that it had something to do with credit and debt, and that the solution to the problem at that time was going to be printing more money, which is exactly what happened, which has caused the tremendous bubble in real estate, just as it did after Greenspan left interest rates very low in 2001, 2, 3, 4, and 5, which resulted in the mortgage mess and almost brought down the economic system. So my point about Hyperwave is sit up and take notice when you can identify them, because something very important is going on, and it is going to affect all other markets. Now, what I'd like to do very quickly is pull up Bitcoin and look at the Bitcoin Hyperwave. Our followers have seen this many, many times, but I think it's important in this discussion to see why and how the effect of some one thing, such as in this case, Bitcoin, and all of its corollaries. It started out with this very long phase 1 period, which was perfect, which began at 1,000 because of a couple of bumps that we had along the way that ran us up as high as 1,000, and then back again to 1,000, where we broke out and started phase 2, 3, 4, the 5 down, the 6 back up, and the 7 that we are still in. The reason I mention this is because of the discussion I just had about the dot-com bubble. The internet stocks had tremendous value. The chip stocks had tremendous value. But what began happening is everybody and his brother began jumping onto that with their own dot-com corporations that had little or no value. And finally, we use the metaphor of barnacles on a ship, just as all of the altcoins that kept adding and forking and adding and forking and adding and forking confused the rest of the world about what this thing Bitcoin was really about. And finally, even with the brilliance of what Bitcoin means to the macroeconomic picture as a way of actually solving the fiat problem, we ended up breaking, going back up in the 6, and had been going down in the 7. So my point in talking Hyperwave, and why Leah and I started this channel, is to get people to get a more expansive view of what this thing is telling us about all of the other markets. And with that diatribe, I will shut up for a second and see if Haeijin's got any points he would like to make.
Haeijin, also, when you do make the points, I would love if you could also explain from what you were seeing during this time when you were making your trades from your Elliott wave perspective.
Absolutely. Absolutely. So I think that I take trades in two different classes. I have a hodl portfolio and I have a trading portfolio. Back in February, I met a client out in, traveled all the way out to Jamaica. And I told him I sold a lot of my hodl portfolio, took huge profits back in February. And all of that money is now being redeployed currently, and I'm laddering in, so to speak. However, I do understand the Hyperwave is now projecting level of 1K, and that's possible. But I think there's a big difference between possible and probable. From a Hyperwave perspective, it is probable for price to go to 1K based on historical success rate of, I believe, prior hyperwaves that completed back to the bottom of the seventh wave, which reached towards the wave one, or phase one. But from a consideration perspective, I think the way I see it, I think from a cycle perspective, and this is also said by Bob Lucas, we have completed 2 full 4-year cycles. And we have probably onset a new cycle of another 200 plus week cycle. From an Elliott wave perspective, I think we have, this correction was probably wave 4, looking at the X semi-log chart of Bitcoin. And if we are finishing or have already finished, let's say, wave 4, then we have wave 5 to go. I am always prepared to be wrong. And if I'm wrong and price goes to 1,000, then so be it. I'll have my stops in place to take me out. But I think cycles and Elliott waves and pattern, maybe I could do a quick share, screen share.
Sure, I just got off. I'd love to see yours.
If you can see my chart.
Yes, we can.
So I've been telling the investor, longer term people, I use a semi-log. This is a weekly chart of Bitcoin using Bitstamp. If you use the 50-week moving average, just that, to decide on your buy, sell modalities, it would have taken you in back around here when price crossed decisively the 50-week and giving you about, and taking you out when price crossed it back down and giving you about 9,000% return. And the same thing, if you bought it here and sold it here, you would have gotten about 2,500% return. Now, the 50-week moving average has a very good fractal relationship to what is going on right now. And if we look at it, we just finished wave 3 here, 4 here back in 2014-15 correction. I'm sorry, we finished 3 and 4 here, and we have a 5 to go. So fractal perspective, back in 2014, price reached to the underbelly side of the 50-week moving average and got promptly slapped back down, but did not make a new lower low. From a cycle perspective, if we look at this cycle right here, we have a right translated cycle. And I think once price gets to near 6K, 6.2K, maybe 6.4 or so, it'll get again rejected by the 50-week moving average and get slapped down, but probably not make a new lower low and give us a completed right translated cycle. Now, that will be the moment of critical differentiation. Will we go down to the 1K, or will we bounce back up just like he did back in 2014-15, got slapped back down, but didn't make a new lower low, and that's when he crossed the 50-week moving average. So I think we may go up until end of May, maybe beginning of June, to the 6K region. Get rejected pretty hard by that 50-week moving average. Maybe go to 3,400 or so. But probably, in my opinion, not make a new lower low. And then turn around and then go sideways for a few months. And maybe October, November, December might be the time frame where we'll complete another right translated cycle, where we'll have a higher low and a progression to a higher high. And that progression to the higher high will enable a decisive cross of that 50-week moving average. To the investor classes, I have been saying, what do you do until you get that buy signal? Nothing. You sit in cash, sit in your hands. The most difficult trade for any trader quite often is no trade. So could we go to 1,000? Absolutely. That is possible. But I think from a wave cycle fractal perspective, there is a pretty good probable chance for this right translated cycle to complete and another one to happen based on the fractal. And we'll get a buy signal just like we did in 2014-15, probably sometime in the maybe late fall. That's how I see it.
That's terrific. Let me just ask you one question. If you could just pull that back up again. If we, on this next down leg, do go to new lows below 3,000, what would your interpretation be at that point?
Well, even if it goes to 1,000, let's say, as long as it doesn't overlap with this peak, it should be okay. I'm sorry, that is at 1165. So if we go to 1,000, I think this will be the wave 5 right here. That'll be the alternate count. So if we go to 1,000 and we go below this peak of 1165, this will be a wave 5, and we're going to go retrace probably below that.
Fabulous. That's terrific. I heard you say that before. I just wanted to clarify that. If you happen to have an S&P chart, I heard a brilliant analysis by you. I guess I call people's analysis brilliant when they agree with me. But other than that, I'm going to pull up a quick chart of the S&P myself.
And Tyler?
Yes, go ahead.
Before you do that, can you pull your chart back up? What I'd like to ask is why you think that Hyperwave, given that we're 99.9% definite but in the belief that it will go down to 1,000, that Hyperwave may not, that's me, abide by the rules that we're seeing right now in Haeijin's chart of Elliott wave? Well,
it would. That's the whole point of using multiple systems, that you don't want to be married to anything regardless of what the probability is you think. That's why I wanted to ask Haeijin on his last chart, what happens, he's predicting some kind of a test or drop, and the whole question is, where does it end? If it ends at 3,180 or above, that's a successful test of the bottom, and then going up has all kinds of new implications. If, on the other hand, it does not, which is what I suspect is going to happen, then all of a sudden new implications come in. One of the ways I test any one of my systems is with another system called consensual. If you can see that on the chart, what this is, these are just 3 moving averages that I've done a lot of study with over the years in terms of trying to determine when a bull market is ending and a bear market is beginning. And with just price and 2 moving averages, there's approximately 13 different steps that need to take place to go from a bull to a bear market. When you add a 3rd moving average, that number jumps up to over 1,028 different steps that take place to go from a bull to a bear or a bear to a bull. What we are looking at now is a 2, 7, and 30-week moving average of Bitcoin price. And just very quickly to show that I'm not cheating, there is the price. Price does not matter when you are looking at what I call the consensual trading system. And what you see here is all this activity on the right is giving some signals that the short term has been strong enough to cross above both the intermediate and the long term, but the long term is still moving down. And to me, the final piece of the puzzle would take place when the intermediate term crosses above that long term, in this case 30-week moving average, and then stays there long enough to flatten out that moving average and turn to the upside. And obviously the only way that takes place is if price stays above this action. So what is about to happen on any retest of 3,100 is this short term is going to move back down below the long term. As soon as it cuts through the purple line, which is a 7-week moving average, will turn down also, and we will be back fully in a bear market. Right now, we are in a bear market because of a number of things. Number one is we haven't got to the final target, but most importantly, because longer term moving averages, including the 200-day, are questionable at this time, and therefore no way to draw any conclusions about it. Now, I am going to pull up one other thing here very quickly because we're going to run out of time. Yes.
Right. We have about 10 minutes left. I think you want to pull up the S&P.
Yeah.
We can definitely do that. I have one more question to Haeijin, though, if that's okay.
Good.
Great. So Haeijin, as you're seeing, Tyler has this moving average technical analysis system of consensual that we overlay with Hyperwave. We like using SARs. We like using Copic curve. We like using MACD. We put on RSI and in a priority order for TIE. If I understand correctly, and sorry it's so loud here, you overlaid the fibs, and you were talking about the Fibonacci's earlier, and again with your mathematical background, very often with your Elliott waves. So just given that we're going off of Tyler showing consensual and his, how he overlays moving averages with consensual, can you just, while we're staying on Bitcoin, given that we don't have all that much time, can you talk just a tiny bit why, you utilize Fibonacci so much, and if, any other analysis you want to throw in of what you're seeing with Tyler's, if you agree, disagree, anything else you want to say there?
Sure.
Sorry, big question.
No worries. By use of Fibonacci, what I feel about a Fibonacci layout is sometimes too much of a cookie cutter set. And I think there's always elasticity in any price movement. And just throwing down a Fibonacci chart on a price chart, it's almost like trying to put a cookie cutter and say you have to fit this degree of cookie cutter trends and have no exceptions. Well, for me, I think the elasticity of the price movement is also a reflection of the elasticity of sentiment. And you have to give way for those exceptions. So when a price doesn't land exactly at 0.5 or 0.618, that elasticity kicks in. Thereby, instead of using only just a cookie cutter Fibonacci layout, I more often use the support and resistance zones that come closer or within the elastic boundaries of those Fibonacci levels to really decide on my entry or exit points or what have you. But for me, the best time to buy is when? Is at the terminal end of a correction. You don't buy at the top of wave 5, so you don't buy at the top of wave 3, the actionary waves. So what is Bitcoin happening right now? I think the Bitcoin is going through a major correction. When is the best time to buy? At the terminal end of the correction. As an analyst, my job is to identify the most probable terminal phase of that correction. I think we're there. I may be wrong, of course. I'm always willing to pivot if I'm wrong. But I think we're there based on the cycles, Elliott waves, and fractals. Now, from a philosophical perspective, there is a major sentiment, social mentality change going on, and that is the perception of money. That is a perception of government, the perception of banks, perception of how we as individuals and society live and work and want to survive together. I don't think I mean, first of all, the fiat system will be around for quite a while. It takes even a person who spends all he has in credit very long time to go bankrupt. And it just takes longer for USA to go bankrupt. To expect the USA to implode into bankruptcy in a year or so, I think is ridiculous. It doesn't work that way. So you can collect all the physical cash you want, put all the money into the T-bonds, et cetera, whatever, waiting for that crash. And still, even in 2008, even Robert Prechter was wrong. So even the great Robert Prechter is and can be wrong. Having said that, the social change in how sentiment is going to drive this is really going to be what the ultimate decision maker is going to be. And I think for Bitcoin is going to be on the favorable side, that society will accept, society will use, and society will actually, this will go Main Street. And once it does go Main Street, that's when the real bubble potentially could occur. This is the smallest bubble I've seen in my short life of almost 50 years. And in my case, I think that if you look from peak to peak to peak, every time people called the peak of a bubble for Bitcoin, well, this is the only bubble I've seen where Mr. Lee himself, the analyst, says that after each popping of the bubble, we hit a new high. I think that he's on the right side from that as a reflection of the social sentiment that's going on now.
That's brilliant. I agree with everything you just said. I don't know if you had a chance to read Leah and my Medium article where we're projecting Bitcoin up well above 1 million and probably 5 million or 10 million before it is actually playing the role it needs to play. And I fully expect that to happen, but not in the next week and a half. It's 20 years away, and we will go through a process. The first thing we need to do is clean up the crypto space and get Bitcoin free of the tethers of all the other problems within the space, and then we can begin moving up. But along with what you said, I've pulled up an S&P chart because of something remarkable going on. I was thinking for the last 18 months that this pattern was a topping pattern, and particularly this break of what I assumed to be a phase 4 of a hyperwave. This being the phase 3, this the 4, which ran from 2016 up to the peak in September. When we broke that, we of course went completely to cash, which was the first time in 10 years we had done that for our clients. But the fact that we dropped down very close to the old phase 3 line has got me reconfiguring my thoughts. You will see here the phase 2 line included both the drop in 2000 to 2003 and the drop from 2007 to 2009 almost precisely. We came down and touched to the tick that phase 2 line, which also means the phase 1 line went for many, many years prior to that. So we're talking about one of the largest potential hyperwaves, and we are still in a phase 3. Now, because the phase, if this was a phase 5 and a 6, then we cannot get above the peak of what would have been a phase 4. If we do, that says the phase 4 was never in play. We were still in a phase 3 tested by this drop. If, on the other hand, we turn down from here, we still run the potential of coming down again to the phase 3 line on multiple occasions. Bitcoin did it on 11 different occasions before the phase 3 broke, and then fell down to the phase 2, which was at 6,000 when that broke. And now there's nothing below the phase 2 until you get back to phase 1. But the S&P 500 is telling a different story. And this is true with the Dow and the NASDAQ and the NASDAQ 100, not yet with the Dow Transports, the Russell 2000, or any of the mid-cap indexes, but we're getting close, within 1 or 2 percentage points. I could show the same chart pattern. But what I wanted to point out as we're ending this is your brilliant analysis of the S&P that showed much higher potential Elliott counts, up to 3,500 and even 5,000, and I think you even squeaked in 7,500. Would you mind commenting on that?
Sure. I think most analysts for the S&P 500, prior to the recent correction, were calling where you would call your old wave, the phase 4 line peak, as the peak where, the stock market will go to the depression era levels, et cetera, what have you. And I was a little bit skeptical. And as I saw the bounce coming, I realized, well, I think this was an expanded flat of an ABC where the B rises above the origination of A. If that was an ABC, that's a wave 4. And that means we're on a wave 5. I also identified an inverse head and shoulders, a massive one, that'll take us to the 3,500 plus levels. What I think is 2 things. I think this wave 5 could be extended to the 7Ks. The scary part of an extended wave 5 is that it really falls quite often to the prior wave 2 level of a lesser degree. For cryptos, it falls, especially for altcoins, an extended wave 5, which most altcoins had, means the price will fall to the prior wave 2. And that's pretty much what it's done, or more. Now, if it extends, I think we'll still be in a secular bull market maybe for another 3 to 5 years. I don't know. If that's the case, I don't think that's necessarily bad for Bitcoin. Why? So if sentiment is uber bullish to drive the star equity markets, that should not necessarily hurt the sentiment towards Bitcoin. The positivity should overflow into it. Many think that they should be inversely correlated. I don't think they're correlated at all so far. But maybe with the turn in the sentiment for the wave 5 coming, or started already, for the S&P 500, that positivity should lend support to Bitcoin as well. Person or society in negative sentiment are rarely receptive to new moves, but only in this positive note of sentiment, I think, should have good spillover effects for the price of Bitcoin to come.
Wonderful. Haeijin, thank you so much. We need many, many more hours, and I certainly will love to continue this. But this has been a great start, getting to know each other, getting to take a look at various aspects of technical analysis. Leah, thank you so much for setting it up and keeping us on track. And with that, I'm going to turn it back over to Leah.
Thank you very much.
Thank you, Haeijin, so much for coming on. This was great, and hopefully for sure we'll do more shows together. And Tyler, yeah, thank you so much. All right, everybody, have a great day.
Bye-bye.